In this week's update, the old classic, bad news equals good news for equities and rotation. What happened to lithium stocks and how best to think about the current market conditions. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. All right, lots to talk about this week. There's been plenty of ups and downs in the market, very abrupt session by session moves. So I guess the big question here is, has a major low been reached a couple of weeks back? And as I covered last week, just looking at the weight of evidence and the balance of things that would support that and things that are against it, there were a lot more things on the supporting side than on the negative side. Has the last week changed anything? No, not really, but it didn't kick on as strongly as would have been ideal. So you can't really say for sure that we've seen a major low at this point in time, but I think I can say with a fair amount of confidence that the bottoming process has at least started. And if you think back a week or two, I did say that the low in the market, the major low in the market, is not a single day event. It's a process, and sometimes markets will go up and down in a bit of a W sort of pattern before the momentum starts to build. You know, there's a lot of things for the market to be concerned about at the moment, and you know, they're keeping a lot of people on edge. But I think that the process of bottoming has commenced, and therefore we're not that far away from from some better trading conditions. But I wouldn't rule out another thrust to the downside. It's possible. Now, the dilemma that central banks have that are looking at raising rates is that the traditional impact of raising rates is to reduce discretionary demand, just to take the heat out of the economy. And that's how interest rates are typically used. But we're in a very rare situation. I don't know if we've ever had anything like this sort of combination of economic factors before, but it's the non-discretionary demand where we're seeing very, very significant inflation. It's in food prices, thanks a lot to the Ukraine-Russian war. It's certainly in petrol prices, which were going to be going up anyway, but the Ukraine situation has exacerbated that. And just general energy price increases as the world tries to make a very rapid transition to decarbonisation. So they're all having very significant impact on non-discretionary demand. You know, I mean, you've got to have food and you've got to have energy and petrol. And so I'm not sure that central banks raising rates is actually going to do much, which really puts central banks in a very tough position. Do they raise rates, which is sort of like pushing on a bit of a string, really, and end up crashing the economy? And I just can't see central banks doing that. They've done too much work in the last 10 years to keep economies buoyant, to go and crash it now on an ideology of fighting inflation with the wrong tools. And I think that's the situation that we're in. The danger here could be that it becomes a self-reinforcing spiral. So there's a lot of uncertainty around markets at the moment. That's for sure. All right, now all we have is probabilities, and right now it pays to be conservative, in my view. And therefore I start to turn my attention, obviously, to where are the strongest technical trends, but also from a fundamental point of view, what's likely to do well if economies get challenged, if consumers get challenged. What are the stocks that are going to march on anyway, or the sectors? So the first and very obvious one is energy. And what the Ukraine war has done, it's just amplified the very stark reality that we've had underinvestment in fossil fuel exploration for a long period of time. And it's not going to come back. There's just too much community opposition to the development of fossil fuels. And from a purely commercial point of view, who's going to finance a project that would normally be a 30-year type project when it's highly unlikely, or there's no certainty that that project would ever go the distance. Project might only last 10 years. They're trying to phase out coal in Australia by 2035. So who's going to finance a project that really should run till at least 2050 when there's severe doubt that it's even going to last the distance? So I think that really underpins from a supply and demand point of view, strength in energy prices for a long period of time to come. And I think you've got to be realistic and say that the probabilities heavily favour energy prices continuing to rise. I know they're painful enough for a lot of people in Australia already, but they could get significantly worse yet. The next area is stocks, and this is not really a sector-specific comment, but just looking for stocks that have got undeniable earnings growth. Irrespective of what happens, whether interest rates go up or commodities economies go into recessions, or whatever happens, there are companies that are going to have earnings growth that's going to be solid for many years to come. Those companies will also need to have very low to modest debt, or in fact net cash on the balance sheet. They need to have strong return on invested capital. They need to be able to fund their growth from free cash flow, because if markets get sticky, it's going to be hard to raise capital, to raise new funds for growth at a price that makes sense without diluting existing shareholders too much. So they need to be able to fund their growth from free cash flow, and they need pricing power. If we're in an inflationary environment, which there's no question that we are, then costs are going up for everybody. And it's only the companies that can pass those costs on to the consumer that are going to be able to stay ahead of the game. So whatever company you're looking at, you need to make sure that they've got the ability to raise their prices and that demand, it's not going to kill demand by raising their prices. The next area is agriculture. Obviously, the need for food is pretty obvious, and this whole situation has been a long-term issue with supply and demand for food. But now the situation with Ukraine and Russia, that were major exporters of just so many food products, that it's made things really difficult. So that would be another area where higher commodity prices would appear to be an extremely high probability. But looking at it from a fundamental point of view is not the only way to look at it, because from a fundamental point of view, prices can do something totally different in the short term and the medium term to what you would think was logical. The most important thing, it's not what prices should be doing based on the fundamentals, it's what prices are doing. It's where the money is actually flowing. Where is the big money actually, placing their bets? That's the most important thing. So on that point, let's look at a couple of charts. So we'll start with the normal spread charts, and you can see we had a good part to last week, and then Friday we got a bit of a turn down again. This is the NASDAQ versus the S&P. So look, we've had a decent bounce, and it was quite a strong bounce. But in terms of this committed rotation back to growth, and the markets really aren't going to go very far until we see a rotation back to growth. So it's a bit indecisive at the moment, bit hard to call. I would have liked to have seen this kick on, but if it can kick on next week and particularly get up above this little high here, then that would be a very positive signal. This is consumer discretionary versus consumer staples, and we saw tremendous strength in the consumer discretionary sector. Cooled off a little bit on Friday, but this spread chart is continuing to be pretty encouraging, and I'll show you another chart in a minute of specifically the consumer discretionary chart, which adds a bit more weight to that. This is Russell 1000 growth versus value. It looks very similar to the other charts, so no real change there. It was looking very positive until we got a bit of a pause on Friday. But I will add that the indices on Friday, the S&P was down about 1.5%, the Nasdaq a bit over 2%, and at the index level, they look like a pretty ordinary session. But when you look at a couple of hundred individual stock charts, there were very, very few that looked nasty. Very few. So I actually got a much better feeling for the market looking at the individual stock level. So that was interesting, and I haven't been able to say that for a little while. And this is the small cap growth versus small cap value. Actually, again, a little bit of an improvement there. Now, let's look at XLY. So this is consumer discretionary, and you can see clearly we remain in downtrend. Yes, we've had a rally, and that rally has taken us up. We've broken through that short-term resistance that would have occurred around this peak. But then we came back down again on Friday. Now, a good part of the reason for that is that Tesla forms nearly 20% of the ETF, and Amazon forms another 20%. So those two stocks form 40% of consumer discretionary. Now, if you look at what Tesla's doing, Tesla is quite clearly now in downtrend. We've now broken key support. We had a little rally, but it fell away again. And look at the rising volume. Look at the candle on Friday. It's quite negative. This is one of the most negative candles that I saw in Friday's session. Volume is up. So I would say that there's every chance now that Tesla will probably continue to the downside. And I've been speaking about Tesla for quite some time, and I said a while ago that until Tesla got washed out, because everything eventually does get washed out in a bear market correction, that until Tesla got to somewhere between 400 and 500, I didn't feel comfortable that we'd seen the lows in the market. And I think there's every chance that that could get fulfilled. Now, it may not happen quickly. If it happens slowly, it may not have that much effect on the rest of the market. It'll be a bit of a drag on the consumer discretionary sector, but these aren't the only charts that we should be looking at. But we've managed to rally back to the 20-day. That was all. Couldn't go any further, and now we've turned over again. The rally on Thursday, when the rest of the market was incredibly powerful, we've got a bit of a long tail on the top here. The volume wasn't particularly exciting, so I would say that Tesla underperformed on Thursday, and then it definitely underperformed on Friday. So that does have an impact certainly on this sector chart. If we look at XLK, so this is technology overall sector, then we've formed a new short-term high. So we've now got higher highs. Remains to be seen whether we've got a higher low or not yet. But if this level holds on XLK, then I think we're in pretty good shape, and that would help a lot. You can see volumes though have really died away. So it's almost like this was capitulation here. Look at the volumes in the run down to the middle of May. This really does look like capitulation, and now we may be heading back up. But I'd like to see a lot more volume in here. This isn't terribly encouraging yet at this point in time. And of course, this is XLE. I've shown this chart nearly every week. This is where the safest returns are. Look at the trend. The trend is strong. You go back to XLK. You look at all the moving averages have all rolled over. They're all pointing down, and the moving average is below all of them except the 20-day. Whereas you look at energy, and all the moving averages are pointing very, very robustly up, and the price is above all of them very comfortably. So, this is going where the money is flowing, not what the fundamentals would say, not what some broker is saying. This is what the money is actually doing, and that's where you need to be. Now, you still need to be careful not to buy into these surges. Don't let the fear of missing out get you. You want to be disciplined and buy the pullbacks, but this is a very, very clear and definite uptrend. I think that was about all. Yes, that was all I had at that point. Okay, let's now have a look at lithium stocks. The pricing around the lithium market is still quite opaque. Yes, we've got a spot market that has recently only come to being thanks to the efforts of Pilbara Mines with the auctions they've been running. But other than that, they're long-term contracts, and the pricing is quite opaque. So that makes it incredibly difficult for anyone, be it Goldman Sachs or Credit Suisse, who are the two brokers that really torpedoed the lithium market last week. It's incredibly difficult for them to make forecasts 1 to 3 years out. There's nobody on the planet can do that because that pricing is pretty opaque and developing very quickly. So how they come up with those reports in the first place is beyond me. The second question is why did traders and investors react so badly is the other question. Now, I'm trying to restrict this just to fact and I think justifiable perspective. I don't think there's much argument that exponential demand surge in the future is a given. There's just too much in favour of renewable energy storage and electric vehicles for there not to be an exponential demand surge. So I think that is an absolute given. And the price gains, the fact that the price of spodumene, raw material, of lithium carbonate, lithium hydroxide have gone up by many, many multiples, 3, 4, 5 times, proves that the demand is just completely outstripping supply. If that wasn't the case, then the price levels wouldn't have gone up as they did. So the question here is, how fast can supply respond? That's really the only question. And the market pricing has been saying that supply is going to struggle big time to catch up. Now, the Goldman Sachs report that caused all the ruffling of feathers at the start of the week would appear to simply add up all the possible new supply that's coming online, with a focus on China getting access to half a dozen mines in Africa. So they've just added all that up and said, all this new supply is coming, therefore we're going to have a supply surplus, and the price is going to crash from $70,000 a tonne to $16,000 a tonne. So, I just don't place a lot of credence on that report, to be honest. If you look at the existing lithium producers, the share prices have been based on long-term contract pricing. The price of all the majors in the world has not been on the basis of spot prices. It's long-term contracts. So they've never been priced at that level. So even if, Goldman Sachs is a quarter right and prices came off significantly, which I think, they probably will long-term, but that's not priced into the share prices. So why should the share prices, fall as much as they did? It just doesn't make a lot of sense. And if you look at Pilbara Mines, for one, it's very cheap. It's on FY23, it's trading on high single-digit PEs, which is incredibly cheap for a growth stock like that. So why a stock that's already cheap can fall 22% in one day is completely beyond me. I could sort of understand if Pilbara Mines was trading on a PE of 30 or 40, that everyone gets really scared and they just dump the shares just in case. But when it's already, barely double-digit PE. I just couldn't fathom the price action during the week at all. Now, this is Alchem, which is the merged vehicle between Orocobre and the other name just escapes me, but it doesn't matter. So just look at the price chart here is the important thing. We've still got strong upward momentum, so the long-term trend on the 200-day moving average is still very strong. The price remains comfortably above it. The short-term moving averages still rising, still well above the 200, so the long-term trend is solid. Short-term trends still solid. Yes, we had a sharp sell on Wednesday, and that may just stun the market for a little while. So I'm not saying that these prices are just going to go straight back up, because when you have this sort of candle, then you've got a huge amount of supply of shares coming into the market. There's no question. So I think this will be like getting smacked in the head with a shovel. It just rings your bells for a little bit, and so I think the market will probably just go around up and down here for a little while, because there was such significant selling, and it might just take a little bit of time to regather composure. But at the moment, there's not really been that much technical damage done there. If we look at Pilbara is a little bit different in that the trend wasn't as strong before that event, and their sell down event on Wednesday was bigger in percentage terms, and we did take out this low. But in favour is the fact that it very quickly stabilised, and then Friday was quite a nice finish. And you can see finished on the highs. It's a bit hard to call at the moment. I'd need to see some follow through, and I certainly don't want to see the price close below around probably 225. Wouldn't be good for the short term, but the long-term fundamentals, I think this will prove to be just a bit of a blip. And if we look at the world's major lithium supplier, that's Albemarle, then you can see that they had already gone through a bit of a correction, so this price had not been as strong as the Australian ones, and as a consequence, we didn't sell off nearly as much. I think on Wednesday it was only down around 7 or 8%, and then you can see Thursday was very robust, and Friday, given the market was down, Friday was pretty good as well. Turning now to American stocks, the S&P at the index level fell 1.2% for the week. There was a very, very impressive advance on Thursday. It didn't follow through on Friday, so we need a bit more information. But when we look at the overall last 2 weeks, it really does support what I said last week, and that is there is a lot more evidence to suggest that the major low has been formed than there is against. It's not a prediction that it's all done and dusted, but there's certainly more on the positive side than otherwise. The ratio spread charts, still a bit indecisive. That sort of influences me to a degree, and I talked about that earlier. And if you look at the prior week, on a weekly chart, which I don't tend to look at, we tend to focus on the daily and the monthly on the S&P, but the prior week really made a statement in my view. The US, and we'll look at that in a minute, the US dollar index edged a bit higher, but not a lot of change. The 10-year yield was up, got down to 2.7 the week before, we're back to 2.9. But all the technical signs would suggest that we've seen the peak in the 10-year yield. And if that's the case, then it completely brings into question what the Fed is saying in public at the moment, that we're going to have another 7 rate rises this year. Now, the bond market is clearly saying, we don't believe you. It's the only conclusion that you can reach. And the bond market is generally a pretty astute market. So that that is what the money is actually saying at the moment, rather than what the Fed might be trying to say, trying to influence the market to go in the direction that they want it to. The VIX finished mid-20s. It's still high, but it's well down from the mid-30s that we've had for a lot of this year. And the 10-year, 2-year spread is still saying recession is not coming. It's at 0.3 and holding. So the bond market doesn't buy into recession looming. The 10-year yield is not saying recession looming or interest rates going higher. So it's just the reality of the market. Okay, so if we look at the S&P, so this is a daily chart. So you can see we had a very, very strong advance, bearing in mind last week was only a 4-day week in America. We had a very, very strong advance the previous week. Look at these. Look at the length of the candles, where they closed relative to the open. Very, very powerful. We've reached a zone of resistance, so no surprise to see the market selling here. What causes this zone of resistance? Well, it's all the people that bought, up here, and perhaps didn't get out when this breakdown occurred. And so they've endured this lower prices in the market, and when the prices get back to somewhere near where they bought in, they promise themselves that they will sell, and that brings more shares for sale into the market and stops the advance. That's why it happens. So we're still sitting around about this support and resistance area, but if we look at this on a weekly, you can see just the strength of last week or the week before last. And it's akin to what we saw the first week of the mid-March rally. Now, the mid-March rally petered out after only 2.5 weeks. But as I said last week, this time we've got more weight of evidence on the positive side. Back in March, I said that I thought it was too soon for a major low, and I felt that there weren't enough boxes ticked. We haven't had enough of a sell-off. This time there are a lot more boxes ticked, so I wouldn't be surprised if we see this is the major low. So that's the S&P on a weekly chart. If we look at the Nasdaq, because this is the key. There was a very robust close above 12,588, which is this dotted line here, and that was on Thursday. That was very impressive. Backtracked a little and certainly did underperform on Friday. But as I said earlier, when you look at a lot of individual stocks, because these indices are influenced by Amazon and by Tesla, when you strip that out and you look at the broader market, in growth areas, and most of my stocks in my watch list, there's a couple of hundred on my US stock watch list. Most of them are growth stocks, and the share price charts actually look pretty good considering the indices were down by 1.5% to 2.5%. So I find that all pretty encouraging, I must say. Aussie Stocks. $1.71.4, so we've bounced back up we're up about 4 cents in the last couple of weeks. Our index actually finished up 0.8 across the week, so it continues to be the outperforming index around the world. It hasn't fallen as far, and it's bounced back more quickly, and that's largely because of the impact of energy and materials. And I guess the highlight, maybe it wasn't a highlight, maybe it was a low light, was the insanity around lithium. So I've dealt with that one. Turning to precious metals, gold was down by $2, $18.52. The long-term moving averages are flat. This is just a boring market that's going nowhere. There's really no other way to describe it. The Australian dollar gold price still holding close to 2,600. So our gold miners are still extremely profitable. Turning to precious metal stocks on the global stage, they advanced a bit, but pretty unconvincing, I've got to say. So let's take a look at that. So this is gold on a weekly. You can see we're still just trading at the same level that we were at in July of 2000, and that we're almost in the middle of that range. So the range goes from 1670 to 2070, so a $400 range. We're sitting almost smack in the middle of that, and all we've done is just go up and down for 2 years and effectively go nowhere. So, that really epitomizes what's happening in the gold market. And if we look at gold stocks, whilst the gold price is not doing anything, then producers, which is really what is in these ETFs, these are producers, not developers, then they're not doing anything either, because really all that's going to move the price of an established producer is the gold price. Whereas the price of developers can rise as they develop their project. They don't necessarily need the gold price to go up, and that's why my focus is not on producers, it's on high quality, world-class developers that are reasonably well advanced. I think that's the sweet spot if you want to own gold mining stocks. Turning to other commodities, copper was steady, 427. Nickel was down a little bit. We've just got a lot of uncertainty around, is there going to be a global recession? There's a lot of chat about it. A lot of people seem to be convincing themselves that we're heading to a global recession. Certainly the bond market doesn't think so. So that's sort of the short term. But I read this morning Goldman Sachs now sees for copper $100,000 a tonne. I should have put copper there. So the Goldman Sachs report is saying $100,000 a tonne. Now that is about $45 a pound, which is 10 times the current level. So I find that even more unbelievable than their downside call on lithium. And I just can't find any sort of credibility around these Goldman Sachs outlandish reports that are forecasting either massive crashes in the price of a commodity, but at the same time, another commodity also in a similar space, they're forecasting a tenfold rise. I mean, it just leaves me speechless. West Texas Intermediate crude up to 120, and the risks just all remain to the upside for the reasons that I covered at the start. There's a spot copper chart, no real change there. Nickel similarly. Wrapping it up, the reality of trading investing is that long-term prices for, if you're an investor and you're thinking long-term and you honestly don't fret too much about the short-term movement, then yes, take account of the fundamentals and base your decisions around the fundamentals. Not entirely, but you can, pin your hopes on the fundamentals leading to the price outcome you want in the long term. But I stress long term. But if you're like the vast majority of the population, and that is that you can't just think long term, you do get significantly put off by the sort of things that we've had in the first 6 months of this year, then you have to be aware of what short-term prices are doing. And short-term prices are driven by supply and demand and by sentiment. So ideally, what 99% of people want and need is a strong long-term uptrend, like we saw in the energy sector, and short-term weakness to buy. That's the combination that is appropriate for this kind of market conditions. Try to buy, you might pick up some turnarounds and you might do well out of some turnarounds, but if the price has been going down for a significant period of time, then the turnaround becomes more problematic. And the only turnarounds that I would be contemplating would have to be in the megatrend areas, in copper or nickel, or any of those megatrend areas. They would be the only ones. If you've got a stock, because it might be developing a project that's in a long-term downtrend, and it's not in those megatrend areas, then you've really got a lot of things against you. So that's the sweet spot. Long-term uptrend, short-term weakness creates the buying opportunity. And that's even more so in tough markets. So you certainly don't want to be buying into a surging share price at the moment. Portfolio analyst last week, there was a question which I think I really dealt with in the previous Sunday video, but how do we know this isn't just another bear market rally? And look, we don't know for sure is the answer. We can never know for sure until months and months down the track. All we've got, as I said at the start, is weight of evidence, balance of probabilities, how many's on the positive side, how many aspects on the negative side, and just go with that with a sensible game plan and good discipline. And that's all that we've got. The other thing that we looked at was how to counter rising interest rates and inflation. What are the sectors of the market that are going to do well? And I covered that earlier also. So that's it for this week. A lot of information to get past. I hope you took a lot out of it, and I'll be back with you next Sunday. There's the information about the website address and my email address, and I'm sure we'll have another fascinating week on our hands. Cheers for now.